And this, of course, coming on the back of the first interest rate hike among developed nation central banks with the BOE, not to mention that, of course, the Federal Reserve is turning hawkish. So in this environment, why do you expect rates to remain low, and how do you position?
But I think if you look at the overall environment, despite the fact that we're actually recovering, there are still several forms of risk around the environment. Like, for example, what's raging right now is basically the Omicron variant, and that in turn could actually affect growth in the developed cities because of the fact that, if social restrictions actually increase, then that might actually hurt consumption in the next couple of months. Now, we do think that despite the fact that the Federal Reserve is going to be hiking next year, your yields will remain pretty low because your government bonds are actually overvalued, and therefore we need to look for unconventional ways to actually increase our yields on the portfolios. And we're basically saying that private credit is one way. The Asian high yield is something that we like as well. And of course, the senior loans part where, they actually benefit from floating rates, that could perhaps be another way to actually look for higher yields within the portfolio.
What are you expecting in terms of the US dollar, given these more hawkish tones coming from the Fed? And how do you position in this environment?
Yeah, I think going into the FOMC meeting earlier this week, dollar long positionings were basically at an extreme, going all the way back to 2015. And of course, post the announcement itself, there's some profit taking on the dollar. And last night we saw the dollar index actually come off to about just slightly below 96. But on a medium to longer term basis, we do think that the dollar will likely remain strong, given the fact that, you have basically the Federal Reserve actually embarking on a double pace of tapering. We do think that rates will rise next year. And that basically means that the yields on the US dollar will likely increase further and widen the gap between the dollar and the rest of the G4 currencies. That in turn basically means that where the institutional investors are concerned, they are likely to be actually switching to the dollar, looking for higher yields. So we do think that the dollar will probably end next year on a stronger note.
Kelvin, when it comes to equities opportunities in this part of the world, there seems to be a lot more optimism for Japan, particularly if you like cyclicals, if you like that persistent low inflation, and if you like the fact that the corporate earnings outlook has been gradually getting revised upwards. Do you see that as a compelling market?
Yes, I think on a short-term basis, we do like Japan because of the fact that, Japan has been a laggard where the economic recovery is concerned. And if things stand where they are right now, and assuming that Japan is not hit badly by another surge of COVID-19 in the form of the Omicron variant, then I do think that Japan is actually likely to actually outperform on a short-term basis, largely given the fact that it's lagging. There's still quite a fair amount of liquidity, and the Japanese economy seems to be doing pretty well. And in fact, last night, the Japanese government has basically said that if things stand where they are and if the recovery keeps in pace with what they're looking for, then there is a chance that they might actually have to revise some of their QE purchases just to make sure that the economy does not go into a inflationary mode like what we are seeing in the US at the moment.
Some of the analyst calls for China in 2022 are eyebrow-raising, let's just put it that way, right? Do you think the amount of optimism when it comes to a recovery in Chinese equities is warranted?
Yeah, that's always the tricky part, right, where China is concerned. I think if you look at the valuations, the Chinese market is cheap. If you look at the Chinese high yield issuers, it is actually very, very cheap. Now, we do think that the worst is over for the Chinese equities market. But at the same time, you can't really discern the catalysts in the near horizon. In fact, if you look at where the things stand, we really need the situation in the property market to actually settle before investors, whether it's institutional or retail, are likely to actually power back into the Chinese market. But if you look at China, on a relative basis, China has actually underperformed by about 40% versus the MSCI World Equities and versus the European and the US equities as well. And 40% is a huge margin, right? And if you look at the valuations again, valuations in China is cheap. But at the same time, what we think is probably likely to happen is that 2022 will probably see a weaker yuan, right? A weaker Chinese yuan. And that has actually already started because of the fact that, just a couple of weeks ago, the Chinese government actually increased the reserve requirement FX ratio for the local banks. And that is a signal to the market that they are actually quite uncomfortable with the strength of the renminbi versus the US dollar. Now, if the yuan weakens, that in turn usually portends that the Chinese A shares will probably be weaker as well, because the correlation between the yuan and the Chinese A shares is actually pretty strong. So at this point in time, the H shares seem to be quite undervalued, and we do think that where the H shares are concerned, they still seem to be pretty better value compared to the A shares index.
Kelvin, before we let you go, and I'm pretty sure this will be the last time in this year that we'll speak to you, let me get to our question of the day. From stocks to FX, what are your big calls for the new year? How does the pandemic tapering, or as you say, in the case of the PBOC, easing economic growth and rate hikes play out in your market calls?
Yeah. We're optimistic that 2022 will be a year where despite the fact that liquidity conditions in the developed markets are tightening, I think on the Chinese side, you're probably going to see the other opposite, right? Because China was the first economy to be hit by COVID-19, first to recover, and therefore it was the first economy to actually experience tightening as well earlier this year. In 2022, we do think that the Chinese will probably have to actually ease credit growth in the Chinese economy, because if not, then economic growth in China will come in at about 5.4%, which is way below the 5.8 to 6% target that the Chinese government has set. So we are actually optimistic that 2022 will be a much better year for Chinese equities.